Welcome back in investors. If you've been subscribed to the channel, you guys know I am a stickler when it comes down to fundamentals. Now, fundamentals are a horrible timing mechanism. We all know that stocks can remain crazy for an extended period of time, both to the downside and the upside. But on this channel, we always stay focused on the fundamentals and we always stay focused on total returns. Yes, dividends are nice and that can complement total returns, but our main goal here is to buy depressed assets and sell them for a premium. And it's definitely getting harder and harder to find those undervalued stocks in a very expensive market, regardless of what metrics you're looking at, whether it's the CAPE, whether it's the PE ratio, whether it's the forward PE ratio, whether it's the Buffett indicator, whether it's debt to GDP. There is so many different metrics we can look at and say, well, this market is very expensive, but does that mean we should stop investing? No, because we can look around all different asset classes and see opportunities. Now, for me, I definitely think some of the laggers of 2024 could be the buyers of 2025. While 2024 brought us a picture of AI and the capabilities that AI has, it's brought valuations up to extreme levels and people are dumping money at high valuations. Now, I've done many different analysis and I could say that overall, I probably have between a 75 to 80% accuracy rate if you're really looking at what I'm saying and you're watching the video from beginning to end. I think of videos like Zoom that I've called out that have been outperformers. PayPal, I recommended Palantir between $6 and $7. Now the stock is around $80 a share, which is just crazy. And of course, I don't own any. Now there have been some stocks that I've been wrong on, and that is part of investing. Sometimes companies mislead and they're just not executing to the standard of our analysis, and that becomes the problem, and that's where valuations can obviously be a trap for most people. Now, when investing, we all have different objectives. Maybe some of us want a dividend yield. Maybe some of us have a high risk tolerance and are looking to hit home runs and don't care if a stock goes to zero. Some of us maybe are more conservative and want those deep value names that are going to be there and we can sleep at night. And some people actually want a yield in their portfolio. But at the end of the day, your total return should be your main focus. Because if we're putting the time and effort into buying something, we have to get a high enough return where it makes sense to keep putting the time and effort into something. Now, just going through some of the analysis back in history, one of the ones that really stick out to me was definitely Raytheon Technology, ticker symbol RTX. This was trading around $65, $70. We can see here that I had an ideal stock price of $73 with a future value sitting close to $175. We can see here on October 13th, 2023, the stock was trading at those levels and now has made a massive move up 71% in a very short period of time. And so valuations do matter in the end, and they do present these opportunities. Now, the most recent one that I did was Dutch Brothers. This one is taking off, and I'm actually getting concerned with the valuation here. We were looking between $20 and $25. As we see from a free cash flow standpoint, we're looking at $11 a share. But with these high growth names, you get that massive separation from multiple to EBITDA to what their free cash flows are going to be. And this is why I put a $20 to $25 stock price on Dutch Brothers. You guys can see here that Dutch Brothers was trading in the 20s a few different times, did get into the 30s, and then skyrocketed up to over $60 a share. Now, I am definitely getting concerned with the valuations at these levels. Now, of course, I am not perfect. I've definitely gotten burned on a few different names here. I went a little too overweight on healthcare. Healthcare was a massive lagger in 2024, but once again, I am not done with healthcare. I'm going back to the board with healthcare because I do think that it will be an outperformer. We look at companies like CVS that really let us down. Now, originally I had a $52 to $53 stock price on CVS, and it just underperformed. Management was not executing, and so we had to rerun our numbers, and now we're looking closer to a $45 to $50 stock price. And probably one of the most popular stocks that I've covered on the channel has been SoFi. To me, this was a $4 to $5 stock, and it did hit those levels numerous times. And I said I would understand if you were buying around $6 a share, where I get a fair market value sitting close to $10 a share by 2030, and we are blowing past that. Now, obviously, I need to update these numbers. The company's taking a different direction, and multiple expansion is definitely happening, and rightfully so. This is definitely a parabolic chart here. Obviously, you guys can see that this was trading around $5, $6 a share, now shot up to 138%. And we're also seeing this with names like Robinhood as well, similar chart pattern. So we're seeing this huge move in a lot of financial institutes, but specifically these smaller cap, oversold, and heavily shorted names have been massive outperformers. And even for a value investor like myself, somebody who really crunches the numbers and tries to figure out where opportunities are, these were buys at those levels. Now it becomes a hard problem of when do you start selling at these nosebleed levels. And I personally, if you're a long-term holder of these names, I personally would probably be selling small positions or writing covered calls against them, collecting premiums and having those positions called away with the hopes to possibly buy back in cheaper once again, because these moves tend to look very parabolic and I'm not so sure they're going to be long-lived and sustained valuations, but who knows, markets can remain irrational. So now what I would like to do is plug in some names that I believe are still undervalued and that have hit recent price points that I've done analysis on. So let's get right into some of the names that I'm talking about, and we're going to keep track of the performance of these names to see if they become outperformers for 2025. Now, the first up here is either going to be a love or hate for most of the subscribers on this channel, for sure. That's going to be Intel. Now, ideally, I thought this was a great buy between $17 to $18 a share. I think that there are a lot of assets within this company, and there's multiple ways to create value with Intel, whether it's breaking off into different businesses or it's actually an acquisition target at these levels as well. With the movement of AI, the amount of money we're spending on chips, I do think Intel is still going to be here, still going to be a performer, and has tremendous opportunity to still capture a large market share. Yes, Nvidia is winning the race. Is it more likely that Nvidia becomes a $6-7 trillion company? Or is it more likely that Intel can actually get things squared away, become a player once again, and go from a $90 billion market cap to possibly a $200 billion market cap? So what I'm going to do is actually put this as one of the first stocks of 2025 that have been a massive underperformer in 2024 that I do think could be an outperformer in 2025. And I'm going to use that $19.15 as my purchase price. So currently the stock is trading around $20.80. I did the analysis about a year ago, and the stock really hasn't moved outside of that 18 to call it $21 mark, and we've had multiple chances to accumulate between $18 and $19. So I'm trying to be fair here and say that I accumulated some at the beginning of January at $19.15. So with interest rates being a topic of conversation for 2024, we're seeing that Feds are at least holding still, maybe even cutting, which then leads me to think that real estate could be an outperformer versus what we've seen over the last couple of years of being an underperformer. Now, if you've been subscribed to the channel, you guys know I've really been hard on REITs, and I still think a lot of REITs have problems, but I think VICI is actually set up a little differently than most REITs. And so we can see here that it was trading around $28.21 on January 10th. This is a stock that I think is actually more interesting, around $26, but we're not going to fuss about a few dollars here. What I'm trying to do is show that maybe the laggards could be the leaders in 2025. The one thing I like about VICI is the company is still growing revenue pretty consistently. The valuation is very cheap when we compare them to their peers, and it does pay a decent dividend, where most of the returns are going to come from your REITs are definitely going to be from the dividend yield. So with it paying nearly a 6% dividend, we basically need about a 6% appreciation in the stock price to get a double-digit rate of return. So I look at VICI and I think it's been an underperformer. I think the backdrop is actually going to be supportive. The next stock is one I brought up numerous times here, and that's going to be Mosaic. This is a company between $22 to $23 I was very, very interested in here, and we could see that around $22.50 was where I was looking to buy. And we can see here on January 2nd, it was trading for right around $24.38, which puts it in the wheelhouse of my valuation. And we also have a nice yield here of over 3%. So we're going to add Mosaic as the third company onto this portfolio that we're tracking. Next up is definitely going to be a curveball for most. I think this is tremendously undervalued. Now, it's in the streaming business. It's been left for dead, and it is Paramount Pictures. You guys can see here around $11 a share is where I actually think Paramount Pictures gets pretty interesting here. It is trading around $11 a share. Now, this one to me is a little bit more high risk, so I probably would have tried to get it a little bit cheaper here. And take a look at this. It was trading at $10.16 not that long ago, so I'm just going to use $10.50 as a jumping off point, because I would have had multiple chances throughout the month of January to accumulate shares around this level. So I'm going to use $10.50 as my purchasing price. Now, of course, I have to throw Pfizer up there as well. This is one that, you know, between $20 to $24 a share, I think is very interesting. It's had its problems, and I'm hoping that they right this ship here. It seems like earnings are actually going to start increasing. They recently raised their dividend. So all signs are pointing to maybe there's a bottom in this stock, and we are pretty close to our ideal price target here. Once again, massive underperformer. This was pushing a $60 stock down to 58%. and it's trading right around $26 a share. Very similar to VICI here, when we're talking about total returns, we're looking at over a 6.5% dividend yield, so we only need about a 5 to 6% rate of return from the equity itself, which will then give us an annualized rate of return of over 10-11%. So these are a few names that I'm actually starting to find pretty interesting. Obviously, they're a little bit more higher risk, high reward type of names, but something like Mosaic, whether we look at something like Pfizer. So leave a comment down below letting me know what stocks you think could actually outperform in 2025 that may have been pretty big laggers in 2024. Just keep track of the stocks that are still hitting my price targets, that haven't outperformed yet, and wanted to put them up here to see what they do in 2025. As always, guys, really appreciate your time. We're going to be adding more names to this list, and we will see you all in the next one.